So hello and welcome back everyone to another one-on-one with Jerry Hall. Now I haven't been doing a whole lot of interviews, but this one I'm really glad that I took the time to reach out to this young man and do what it took to secure setting up that interview because I really enjoyed this conversation. I think you're going to also. This young man is Liam Connor from Confident in Crypto. He's got a great little YouTube channel. And I found him as I was exploring various projects in the Cosmos ecosystem. We all talk a lot about the necessity for interoperability. And we ask questions like, when is the Wi-Fi moment going to happen for digital assets? Well, Liam is on the same quest that I am to find good quality projects that not only give us an opportunity to prosper through appreciation as an investor, but also understand the dynamics and the intricacies of these new layer 1, layer 1.5, layer 2 protocols, as well as new apps that are coming to the system, because this big world of digital assets is getting more and more complex on one side of the equation and simpler on the other. And we get to decide which of the playgrounds we want to play in. Me, I like ease of use. And Cosmos ecosystem brings that in spades, especially when you're used to what's going on in Ethereum. So finding out what these avalanches, Solanos, Cosmos, Lunas, etc., what these projects are doing and how they're making it easier and easier for us to transact. It's just a really good thing. I hope you enjoyed this hour talk as much as I enjoyed having it. Enjoy. See you on the backside. So Liam, I am so happy to have you here. How are you today?
Doing really good, thanks. Of course, thanks for having me on, Jerry. Really excited just to talk about some of the stuff in the cryptocurrency market. And yeah, it sounds like we'll have a good chat.
Well, some of my best chats in my interviews that I've done have been with fellow enthusiasts, people that are so excited and getting so much from their journey in this investing crypto world that they start YouTube channels and start sharing it with others. That's somebody, when you find that person, it's like an instant connection. It's like, I understand you in a way because you are me. I found something, I'm enjoying it, and I want to share it with other people because I find a tremendous amount of value in it. Why don't we start there? What's been your investment journey? What led you to this world?
You know, it's actually very interesting the way you sort of put that across. Like when it comes to the YouTube side of things, just before I get into the journey, it's very much like you're learning as you go, and then you share that information with other people. So it's super awesome. And you know, if you get onto certain topics that are really interesting, you go down a bit of a rabbit hole and you spend a lot of time on it. But as for like your question there of like the investment journey, I've always been quite interested in business, right, and economics. So when I was at school, that was the sort of subject that I excelled in the most. And then, you know, a few things happened in my life. We can get into all of that, you know, if you want to. But essentially, my real investing started with Bitcoin, you know, funnily enough. So I actually went straight into cryptocurrency. I always found, as I say, business economics interesting. I always started to start a business or something like that. But yeah, eventually I found Bitcoin. I put some money into Bitcoin, and my knowledge has really excelled or grown, should I say, quite quickly from getting into Bitcoin, because it's quite a steep learning curve when you first get in.
You aren't kidding there. I mean, it's like I've been in this space. So my first dally into cryptocurrency was February 1st, 2018, right after the big blow up 2017, you know, and with all the news media attention and all the stuff, and a buddy had talked to me about it. And I had a bartender in Costa Rica who was talking about it. And I got really interested because I was dabbling in stocks at that particular time and pretty active in my always seeking better ROI, right? as an investor, I think we're always got an eye for, can we apply capital to something and get greater return? And what are the risks involved in that? And that, you know, all the little gyrations that we go through when we analyze things. And crypto presented such a fascinating field of study, number one, but also ROIs that were just like nothing I had ever even heard of, other than a couple of unicorns through the .com explosion that happened for me when I was about your age.
Interesting,
right?
interesting.
But didn't participate. I was busy doing my stuff. I was dating, and, you know, I had a construction business, and I was making tons, you know, I was making very good money for somebody who didn't have like a PhD or, you know, that kind of stuff. And I was doing fine. But this crypto world. So let's get into that. So you discovered Bitcoin, and about when was that? And how fast after you discovered it did you actually put like even the first investment dollar in?
Yeah, it's interesting. You mentioned the .com bubble as something you watched, and it feels like, you know, from your perspective, maybe when you saw cryptocurrency, you kind of had this like, you know, I've seen something like this before, so I want to get involved this time. Kind of similar to what I've gone through, but with the different sort of market cycles within crypto, right? So actually, I first discovered Bitcoin probably around sort of 2015, 2016. My friends were actually purchasing Bitcoin and doing stuff with it. You know, I won't go into the details of what was being done, but essentially they were buying it around $7 a coin. And, you know, that was just a random like first like encounter. And then a couple of years later, you know, I'm working in a call center, and, you know, I'm speaking to someone who knows about Bitcoin, right? And they are saying it's $300. And we're like, yeah, we should definitely buy some. This seems like a good price. You know, we didn't really know anything about markets at this point. A lot of my knowledge in markets and ROI and these kind of things came later. But essentially, we didn't buy it. And then sort of mid 2017, when, you know, it was really exploding in value, Bitcoin was around $2,500 or pounds. I'm not sure which one. I do all my denominations in dollars now, but back then I was doing it in pounds. So it was probably £2,500. And so, yeah, I bought Bitcoin. I just put in a couple of £1,000 or $1,000. And that was how I kind of got in. I didn't really know much about it. It just seemed like it was going up, right? So this is like your classic, you know, doesn't know anything about markets, sees an asset going up pretty quick, thinks, right, I'm getting in on that, you know, especially having seen it at $7 briefly and then 300. So probably a late time to buy when you think about the psychology of it. Mm-hmm. But yeah, obviously the prices did go higher. So that's how I first got in. And then after that, it's just been a wild, you know, journey of learning, successes, failures. And yeah, it's been really interesting.
You know, I think for me, one of the most probably gratifying elements of this whole thing is the people, the relationships that I've made. I've made some incredible relationships with folks that either started as an interview like this, or was maybe some banter back and forth on Twitter, right? And even a couple of other YouTubers with me just putting my comments in their comment section. And then that started a thing that started an email thing that turned into a WhatsApp number exchange, which turned into chatting on the phone every once in a while, or talking over this, or, you know, exploring this. And so that has been wonderful because I learned so much from people, right? I can learn from a book. Yes, I can. I don't know why, though. I tend to learn more from people, right? Especially when I can interact and ask questions along the way. That's been phenomenal. So the people, and then the paradigm around money, how I've changed. I mean, subtly, and then all of a sudden, my entire perception of money has changed. And I can't tell you exactly when it was, but it was sometime after January 2018 and today that a complete just shift. And I don't know how much of it is from crypto forces you to learn about money and monetary policy and things of that nature, but it also has so many philosophical elements to it. I mean, it's just a really an amazing topic to study. It's not just about ROI.
I totally agree.
Wonderful. That is something that helps stimulate the continued enthusiasm around it. But yeah, and so let's jump into that for you, because your channel talks so much about the things that aren't necessarily number go up. It's this element of tech, or let's talk about this yield. Let's talk about calculating yield. One of the greatest things about yield is that it doesn't matter the price of the asset. The math of yield is the math of yield. 0.01 Bitcoin is 0.01 Bitcoin. It doesn't matter. And the same goes for any, proof of stake type of element that you're in, where you're staking or liquidity pool or whatever. Let's dive into that, because you do such a wonderful job presenting that on your channel.
Thank you. And yeah, I think, I understand the point you're making there. I mean, really, when we're looking at, prices of assets, we're talking about units of account, right? We're talking about, are we valuing Bitcoin against the dollar? Are we valuing it against gold? Are we valuing it against stocks? And when we're talking about yield, the only time sort of the dollar comes into play is if you're looking at a yield in terms of getting more dollars, right? And I feel like a lot of the yield that I'm looking at with sort of proof of stake blockchains and so on is more about yield in the sense of getting more of the token that you're holding, essentially, and you're trying to actually get a bigger share in a network which you believe has a lot of potential to grow. But just kind of going back from that, that's where I'm at now as well, looking into yield a lot, just like you. And there's just been like so much to digest along the way. And you mentioned that I don't really cover just the price of assets, on my channel. It's not just number go up. It's not just, this is like a chart pattern that might do this, do that. That's how it started, right? So just to give you a tiny bit of background before we get onto like, yield and stuff, it's basically like I started with Bitcoin 2017, number went up, I was happy. Then it got to sort of, as we all are in those situations. But yeah, and then we got to 2018, the price crashed. At this point, I'd already sold my Bitcoin for Ethereum. Ethereum went up a little bit more. So I was like, yeah, I'm doing something good here. And then I was like, yeah, I'm a genius. What I can go ahead and do now is just buy loads of altcoins and keep cycling my money over and over again. So I bought Ripple, and Ripple went down a lot at the time. I bought it at the peak. And that's when I realized I needed to educate myself, not only in the crypto markets, but also in terms of technical analysis, looking at charts, prices, that sort of thing. And I just went on this wild sort of, almost like going down a rabbit hole, I suppose. Like you say, you have to learn about finance and money before you can start learning a lot of the time about cryptocurrency, because there's that financial element when it comes to the token. So for me, just like you, somewhere between January 2018 and where we are now, I started learning a lot about money and started like completely changing my perception. But I started off doing technical analysis. I just started off doing this sort of like very financial approach, very like, okay, I'm going to look at the charts. I'm going to find good times to buy, good time to sell. And then like over time, I've really shifted towards looking into the actual fundamentals, because technical analysis and number go up can only tell you so much of the picture, right? When it comes to what's going on in the space. I'm not sure how you do your sort of investing, but some people do narratives, for example. They look at the macro backdrop as well. Some people sort of invest using charts, for example, on a longer time horizon. And then some people invest by diving into different sectors and picking up, where the trends are going. I've very much shifted towards a trend-based investment approach. And the yield comes in now, like today, or, in the last, say, 6 months, really because I want to accumulate more of particular assets that I believe have a lot of return. And that's when you start looking at compounding gains. And you start looking at basically getting yield and then compounding the return on that yield with price appreciation. So it's kind of where I've got to myself there.
For me, it was actually kind of lazy at its simplest, but it kind of follows. I don't know how familiar you are with Michael Saylor, but back in like 2011, I had browsed, kind of just skimmed through this book called The Mobile Wave that he wrote. And I didn't think nothing about it, but there were a few things that made sense and that were very recognizable for me. I could understand them. And that was what is dominant before the world understands it's dominant, right? What has established itself as a kind of the toothpaste has left the tube, it can't go back in kind of thing? What does the world know it needs but won't acknowledge it yet kind of thing? And it was pretty easy to see that Amazon was that kind of thing, that Google was that kind of thing. And understanding the value added the value add with the dematerialization of physical things to a digital format. It didn't take great, an Einstein type genius to figure out that that was going to continue to get more and more adoption. That was now that was going to be the dominant theme, is taking material things and digitizing them.
Yeah. Because
of cost, because of efficiency, all these factors. Well, crypto just checked all those boxes immediately for me. I didn't need to study that much to understand that that's where these things were going. And that was just a process of parsing which ones were the ones. And I'm like, man, I don't know. I don't know which one is going to be an Amazon versus a pets.com. So maybe the best thing to do is get a little and get it into a mechanism where it can earn more of itself. So whether that's a Nexo or a third-party platform like Nexo or Celsius or BlockFi, or its own protocol wallet, like with Cardano and Dot and Atom and all the way down the list. And once you take a little piece of something and you have it compounding its own interest on top of itself, then you are literally continuing to invest in it until you stop. Well, that little mechanism has turned, long story short, $23,000 into, well, the market's down, way down today, 500 grand. That one basic philosophy: buy something that will earn more of itself and compound into itself.
Absolutely. I mean, yeah, okay. It makes total sense.
I could not find any mechanism like that in the traditional finance world that had these kind of return profiles.
I think it's an expanding sector, right? That's one of the reasons we have this sort of opportunity. It's like you said before, you sort of identified that Amazon and Google was what the world needs, and they didn't realize it yet. And, they had very low stock prices to where they are today. Some of that's inflation, some of that's just network growth. But in terms of the interest side of things and the compounding returns, I'm not sure what options are available in traditional finance areas, because I haven't done all of the research there. But, for me, I think we have this yield here, partly due to the fact that we're still very early. A lot of these inflationary mechanisms are part of sort of a token distribution when we get to the higher APRs. And maybe that distribution is continuous, but in a lot of cases, it decreases. It's just like with Bitcoin and mining, right? The difference is when you mine Bitcoin, the distribution goes to the miners. But when you're staking on proof of stake, that distribution goes to the token holders. So it's a better distribution in terms of, users or holders or investors getting a piece of the pie. But it does decrease over time, just like we saw with Bitcoin and its reduction to the new supply that's being released.
Well, I mean, unfortunately, in the quote unquote real world, the Teslas and Amazons and Microsofts of the world, they don't have staking mechanisms. But can you imagine identifying Tesla early, buying a few stock, having your stock stake your stock so that you earned more stock?
Great. Sign me up.
I would have done that. I would do that almost with anything that you can see a 30 or 40 year future for. Like I see a 30, 40 year future for compute power.
Mm-hmm.
So Akash in the Cosmos ecosystem is like a no-brainer. Will it survive? I don't know. The concept will. Will somebody else bring a platform that can provide it better? I don't know. But until then, I see when to put a little, and I got a little in, and it's got a staking mechanism, and I couldn't be happier. You know what I mean? And then the other element, and this is how I found you. I found you because when DeFi really came on, and 99.9% of all of it was circulating around the Ethereum world, the cost to participate relative to what I was willing to mess around with to kind of try to learn and understand the mechanisms of your, Uniswaps and 1inch and all these type of things, and to do the little deals and this, that, and the other thing, it was cost prohibitive. So I decided not to. I said, I will just be happy earning my yield and compounding my yield. Then I discovered Cosmos through yield seeking, right? Kava, the little shiny lights of 33%. I said, oh, and then I found Akash, and then I found this, and then I found this, and Osmosis. Anyway, you led me to all these things that I could play with for as little as 50 cents.
That's even expensive.
50 cents worth of value cross-chain on IBC for literally nothing.
Yeah.
Because I'm experimenting with the different elements. You know what I mean? And to get a feel for it with 50 cents is just as fun to me as learning about it with $500.
I mean, it's better. Yeah, I totally agree. Yeah, it's just so much better. And you get that like kind of practice. You can play around with a little bit, and you don't have to worry if it goes wrong because it's only 50 cents. But you also don't have to pay huge fees, so you've got as much experimentation as you need.
Exactly. That's what, and I can create a liquidity pool, which I'd never done before. I mean, I read about it and I understood it, and I understand about impermanent loss, and there are things that I understand. So that's why, understanding that, why would I want to risk $1,000 in a pool that might have one asset explode and the other just go to the toilet?
Yeah.
Right. Well, I can do that with $10, $15 in the Cosmos ecosystem on Osmosis. Right?
Yeah.
I can play out different theses. It's almost, with very little financial risk, but I still get all the learning upside.
And the thing is, you need to learn hands-on. You've got to learn hands-on with cryptocurrency. It's very alien, I think, for a lot of people at the moment. Sure. Although it's very simple once you know it. You pick up generally on what kind of things you need to do or look out for when using different wallets or different blockchains. You have to do actions. You can't just read a manual and say, okay, right, I'm ready to go and provide liquidity on Osmosis. You can't just read a manual and say, right, perfect, I can now create a smart contract on Ethereum. You actually have to do it. And if the fees are $50, $100 a transaction, it's a big barrier for people to experiment, which means it's difficult for people to get on board. But it's even a barrier, I suppose, for people who just want to, try and iterate on actual, like smart contracts and applications that are out there, trying to create new sort of innovations in the space. They can't do that with huge fees. Now you have test nets for that for the developer side, but you don't really have that for the user side so much. You kind of have to do live experimentation, don't you, as a user with real money on chain. So yeah, Cosmos is great for that. You can do it on Polkadot too, Solana. There's a lot of cheaper options than Ethereum, and we can dive into that sort of user standpoint.
Let's do that, because I'll tell you my experience messing around with things beyond the staking, right? So yes, I own Solana. I got it staked. I got Avalanche. I got it staked. I even own a big chunk of Polygon being staked on the Ethereum mainnet, right?
Yeah.
I've obviously got Ethereum, Cardano. I have like 21 different layer 1 smart contract platforms that are all staking, and I'm totally happy with it. But I have not, that's it. That's really, other than what I'm dabbling with in Cosmos now, that's it. I have no experience actually, like I've never built a smart contract. You know what I mean? Yeah. My liquidity pool that I'm messing around with is on Osmosis.
Sure. Yeah.
Talk to me about the fun you're having tinkering, because there's a real joy when you bring new projects that you found. I see it in your face. There's like a glow. For instance, when you were talking about, well, I watched your osmosis video. And
Yeah, I mean,
wow, this guy found gold.
It's really exciting. I mean, it's a lot of theory and it's a lot of work at the same time, you know, especially when we look at the tokenomics and that sort of thing and return on investment. But in terms of playing around, you know, I've had a lot of fun, you know, providing liquidity, seeing what sort of return I get from that on daily or you know, weekly basis sometimes. I really enjoy the research, and I don't think most people do, but I really enjoy looking into like tokenomics, trying to understand, you know, where the value in the token is, where it comes from, what can make the price appreciate. But if you're talking more about tinkering, I've actually found it very interesting to look into more sort of NFTs recently, you know, from the tinkering perspective. I mean, we can talk about osmosis and DeFi, and we can talk about sort of the financial side of things. I find that it may be tinkering, but it's definitely with a financial return in mind, you know, rather than it being just for fun, just to see what happens. But with the NFTs, with creating NFTs, with looking at how you can use NFTs to provide value to your user base, let's say, or your fans or your community is the word I'm looking for. That's really been interesting. And it's almost like NFTs takes this idea of culture and art and creativity and then takes this other culture of finance and almost just like shoves the two together and removes frictions in the sense of, you know, things like royalties or middlemen who have to facilitate, you know, things like royalties or who gets what out of a transaction or legalities. So yeah, I've definitely had fun with NFTs. And like you said, because the fees are so cheap on Cosmos and other chains, it really makes that fun element much easier to do. You know, you said, I'm not sure if you said during the recording, the interview, or just before about the Rarible video I made on YouTube, like how to use Rarible. That was okay. I mean, it wasn't that fun because I was paying $20 every transaction. So I did a couple of like play arounds and then that was it. I was like, I don't need to do this transaction anymore. And I even had people commenting on my video saying like, you know, I'm paying $100 a transaction. And that's because when I made the video, it was only $10 a transaction. But when they were watching it 6 months later, they're paying 100. So you can't have fun on Ethereum in the same way that you can on Cosmos, unless you're rich. You know, it's almost like a rich playground on Ethereum.
The economy of scale thing, right? If you're dealing with $100,000, well, then $100 of fees is nothing. It's nothing.
Yeah, but you wouldn't want to do it 20 times in a day, for example. So that's still enough to say, true. Okay, we're not going to mess around. But yeah, it's not as much. I totally agree with what you're saying there.
My son and I are we're developing down here in Costa Rica. And one of our ideas is that this one of the places is going to have like 4 studio apartments in this kind of like almost tropical lodge type of thing. And I'd like to do an NFT style Airbnb type of thing where each token represents a night. And have them in a marketplace where people can say, well, I want January 3rd through 5th of the Bitcoin suite or the Cosmos studio, you know, and be able to use and have those NFTs be things that can actually be like used. Those are your keys for those dates.
Yeah.
And then have them interact in a subsequent website that represents the facility.
Yeah.
But that would be kind of neat to do something like that. And it's a slow process because my son is the tech guy. We're having to learn this. We're going to have to learn the tech. And then how does that interface with other things that we're going to use, i.e. the website, i.e. what kind of wallet integrations does the website have to use so that it can accommodate that, you know, there's so much to it.
There's so much more as well when you're starting to introduce real world assets. You know, you have to look at the way in which the NFT allows people to get access to the property. You know, do they prove it to someone and they give them the keys, or do you bring up like the NFT on the phone and scan it?
The key.
Yeah, exactly. That's what I was saying there. Yeah, exactly that. And that is kind of cool, because the NFT is giving you the ownership rights, or the rights rather than ownership, to stay in that property on that day, and then you have the wallet which you scan. So that's actually really useful, and it removes that friction of having to give the keys over, having to trust those people to give the keys back. Basically,
that's only one side of that. Over, if you really walk through the experience, there's so much that you can do to reduce friction. There's so many points of friction in so many different things. But in this case of Airbnb, you know, we've identified like 3 major friction points. Major ones: the payment, right? Access and mobility, right? Yep. And then there's other things as far as, you know, how you work with metadata. You know what I mean? Like, you can actually, it's really amazing when you start thinking about it. All the things I wish somebody would have helped me when I started leaving my own home country and going to other places, the little things that sometimes you bump your head against when you're out in the world and you go, oh, I won't do that again. Well, what if that was incorporated in metadata in the deal? And so, you know, you get this NFT and now all of a sudden here's a list. Get your passport, make sure it's good. Okay. How does your bank, this is how your bank might interact with the banking system in this country. This is things you might want to consider. Having a bank or a credit union in your area that pays for foreign transaction fees and doesn't charge you. Do you have Uber? If you don't, maybe you should get it, because it'll help you, blah, you know, and da, 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 da. Just a whole list of things. So much you can do without ever interacting with the human being, so that when you do interact with the human being, it can be human. It can be a relationship thing, not a transactional thing.
Yeah. Yeah, I see that. And yeah, I think digital, just the digital space overall, not just crypto, is great with removing some of those challenges. You know, you can look up online now, for example, just, you know, what problems you could face in another country. You can look at reviews, you know, so you can see like the feedback for something like an Airbnb, etc. But I think, you know, with crypto in particular, what really gets solved is transactions, which you sort of alluded to a little bit there, the friction in transactions, the trust involved in transactions. And yeah, like you say, you can focus on relationships with people rather than transactions and trying to trust them.
Absolutely. I'm looking at the clock. I don't want to abuse your time, but there's some things that I definitely want to get on tape, and that is
Go for it.
And this was it was a little thing, but it was actually very huge. And that was in one of your videos when you were talking about airdrops, and you were talking about staking airdrops, and you were talking about compounding yield within a yield mechanism. You brought this math formula of how to actually determine APR in a project. And I think you went to MintScan to get the information on a particular coin. And so you can share your screen if you want to pull up any of your favorite Cosmo projects, and let's show the world that little juicy math formula.
Sure.
If we can help some people.
So I think, there's 2 parts to like the formula that I've been using recently, and it does adapt and evolve. So don't take this as like a final model, because over time I'll refine it, or, you know, look at better ways to improve it. Let me just share my screen. Well, it should be sharing now. You should be able to see MintScan.
Got it up. And this is the Atom token.
Yeah, so we're on the Atom token right now, but essentially every blockchain's got a block explorer, first of all, where you can look at some of the information on block production. You can look at things like the inflation rate on proof of stake chains. So if we look at this screen, this is Atom. This is MintScan, which covers all the Cosmos chains. You can see on this, you've got a load of different chains you can select. These are all Cosmos chains. And you know, different networks have different block explorers. So if we go to Etherscan, this is the Ethereum block explorer, right? Mm-hmm. This gives you information on Ethereum. These are the gas fees there. If I go back to just the home screen, you can see the market capitalization of Ethereum. You can see the Ether price. You can click on the latest blocks. You know, you get the idea. You've got all the information on these sort of blocks and these chains. But, you know, when we're looking at inflation rates, MintScan, for example, will just tell you the rate of inflation on Cosmos. We can see here it's 9%. But then what we have to work out is what's the staking reward, because the way that staking rewards work is that all of the inflation, the new tokens, the new supply, which on Atom's 9% a year, is distributed to people who stake the Atom token, and that secures the network. So think of it like the way proof of work secures the network, except for the reward is new tokens to people who stake rather than to people who produce blocks, which are the miners. So the way you can calculate basically your return, your staking rewards based on inflation, is to look at what's called bonded tokens as a percentage of the number of tokens in circulation. So bonded tokens are essentially the number of tokens on the network staked as a percentage, which is 62.2%. And so inflation is 9.07%. So that means you've got a minimum of 9.7% return, or 9.07% return a year. You know, that's if 100% of the tokens are bonded, but they're not. You know, only 62.2% are bonded. So that means that 9% is distributed to a smaller number of people, so the yield is higher. Now, hopefully I'm doing this right first time, but if I'm not sort of getting this wrong, what you do is you take the rate of inflation, which is 9.07%,
right,
and you divide it by the number of bonded tokens. Hopefully that's going to be the right equation, because I haven't done it in a while. And then you times it by 100, and that's the percentage return you should get, that's theoretically.
You've done it
for staking. Now, it's not always exact. You know, this data could be slightly wrong. For example, the rewards could be slightly different. And it's dynamic. It changes constantly, you know, especially if you're compounding, for example. That means you're getting more tokens staked, so the percentage of network staking could go up. People could unbond, you know. So this is just kind of like a way to say, okay, what should I get roughly yearly? And then you can start looking at how you can sort of look at what you can get compounded. But there are like certain tools you can use, and I'll just get one up where you can look at just the, you know, staking rewards. Kepler has a couple. So if I just go to the dashboard for Cosmos specifically, you can see 14.58% is the staking rewards. Now let's take a look at the equation, 14.58%. So yeah, we're pretty good on that one. So that's a really good way you can do it. One you might like yourself, Jerry, actually, just for checking out the rewards, is stakingrewards.com.
Oh, okay. Well, that's right. They have that cool little calculator that helps you compound it.
Yes, yeah, exactly. And yeah, you'll just have like, you know, the staking rewards there right away for a lot of tokens, but you know, some of them aren't included. But yeah, let's say we just go on Cosmos for this as well. Yeah, like you say, it's got that cool calculator, so it tells you a few different metrics: staked value, market cap, etc., rewards. Now you can see on here, right, the rewards are slightly lower. The reason is you have to pay validators commission. So this is what I mean by this formula is not refined. It doesn't take into account, you know, 5% validator commission, for example, or 10% commission, and you do need to deduct that, you know, from this formula if you want to be more precise.
Yes, you do.
And I believe that's what staking rewards does. But yeah, you can do compounding. So you can take $1,000, look at 1 year's compounding returns. And what you see is compounding, the chart starts to go up a little bit quicker. You know, if we go to 5 years, look at that curve compared to when it's not compounding.
Exactly.
You know, $1,000 staked for 5 years with staking rewards around 13%, you know, you get $1,600 or so, let's say. But if you compound your rewards, instead you get closer to 2,000. That's really nice, but that's actually nothing compared to some chains because they have much higher staking rewards than Cosmos.
Well, like I told you how I found Kava, because I saw it on Kraken for 20%, knowing that it had to be larger if I went on chain with it. And sure enough, it is.
Yeah.
And then I found Akash, and sure enough, it is. And then I found Osmosis, and sure enough, it is. And finally, Juno, sure enough, it is.
Yeah, absolutely. And those ones are particularly high. Akash, Kava, and Juno especially. But yeah, the reason they're high is the inflation rate's higher. It's 20% for, say, Kava. And the bonded ratio is actually lower as well. So, when you put that same formula in, we'll just do it here quickly. So looking at 20, which is the inflation rate. So what the equation really is inflation rate divided by bonded ratio times 100. So if we go back to MintScan again, 20% inflation rate divided by 58.76. It's just really simple, right? But anyone can do this. It shouldn't be too difficult. Just take a note of the formula and you get 34.03%.
Right. Minus out the 3, like my pool, I'm paying 3%.
Yeah. So yeah, what do we times that by 0.97, taking out that 3%.
Yep.
Yeah, still 33.01. So yeah, it's pretty nice. You have to be careful with some, like Osmosis especially, because all of the inflation on Osmosis doesn't go just to stakers, right? So with something like Osmosis, some of the inflation goes...
So much of it, the liquidity stuff, all the other stuff.
Exactly. So you have to check, how the rewards are distributed, which you can do just by looking up white papers or looking up Medium articles for different projects. But if you're asking like with equations specifically, there is like one equation that I kind of came up with, and I think this is like one that you're referring to, and I call it like the staking ROI multiplier, like return on investment multiplier. But I think a better way to word it, and I have been thinking on this the last couple of weeks, is the better way to word it is actually the market cap return on investment multiplier.
I'm gonna write that down.
Yeah. And the reason is, I take it you're familiar with how market cap works, market capitalization, especially with the traditional sort of background you've got as well. Essentially, I noticed there's a disparity, right, between, especially with crypto, probably not so much with stocks. There's a disparity between a project's market capitalization growth and the growth in the price of the token, meaning that the market cap can grow significantly, but the token price doesn't always grow as significantly. And this is the case for most chains. Bitcoin, they're pretty much tied. There's a little bit of a growth in Bitcoin's market cap, which is more than the price because of the new Bitcoin coming into circulation. But with cryptocurrency chains, especially new ones, there's a massive disparity where, token price might go up 5x, but the market cap might go up. And market cap, for anyone watching, is value of the whole project. So the value of all circulating tokens combined. So you might have it that the token price goes up 5x, market cap goes up 10x, 50x, 20x. And it's for two reasons. One is there's an inflating supply because of proof of stake. And the second reason is because there's sometimes tokens that are locked that get unlocked. And it can be things like tokens distributed to investors or anything of that sort. So, this equation, the market cap return on investment multiplier, takes away token price altogether and says we're going to track the value of the network, the market cap, and we're going to look at how much it grows as a percentage. And then we're going to apply a multiplier to that to see how much our portfolio grows as a percentage. And if you're staking, there's a good chance you're outpacing that market cap growth unless there's a lot of unlocks in the project. So let me see if I can get it up for you. I've got to find a way to get it onto my browser. I've got it here. Just bear with me. Do you have any questions, by the way, while I try to get
that up? You're killing it.
Good to hear. Good to hear. It's already on here. It's saved. Perfect. So you should be able to see on here the equation. So So you got staking return on investment multiplier. So we'll change that to market cap. So I think it's a bit of a better fit. Because you're not looking at the price of the token going up and then multiplying it by a factor. You're looking at the market cap. So what you take is your staking yield. You know, you can even take your liquidity provision yield if you're converting that into the native token. That's still totally fine. But it's all about for staking.
You're right, though. That you have to go back into the native token.
Yes.
Otherwise, it's not. With LP tokens, you are going to go completely sideways. Because there's none of the other you need the other pieces of the equation to make this work. Okay, go ahead.
Yes, definitely. So this is specifically for if you're accumulating the same token that you're getting a yield on. Meaning if I'm providing liquidity on Atom and I'm getting Akash as a reward, the only way this equation works is if you instantly convert your Akash into Atom again. So it's specifically for gaining more of the same asset.
Which, by the way, the equation in the Cosmos ecosystem, because the transaction fees are so short or small. But just saying.
Yeah, I mean, you can compound really easily because of those low transaction fees. But yeah, so you take your yield, right? It doesn't have to be staking. We can put that in brackets. You do yield plus 100 or 100 plus yield, and then you divide it by network inflation plus 100. Just ignore like the plus 100 for a second, right? Okay. We can always like come back to these. But if we just look at this equation here, staking yield divided by network inflation is actually just a ratio, which takes a look at how much return you're getting from staking compared to how much the network number of tokens is growing. So if your staking yield is 10%, so say staking yield equals 10, I know that's not the right way to kind of like write it, but hopefully you're following what I'm saying.
I'm following.
If your staking yield is 10, and you divide that by a network inflation, which is 5, the answer is 10 divided by 5, which is 2. So that means you're outpacing network inflation by a factor of 2 in terms of how much your portfolio is inflating in terms of the number of extra tokens.
You could call that market cap or ROI, or you could just call that value accrue. You know, you're actually the rate that you are accruing value. It's no different than the ratio of, let's say and they did this for years and years and years, by the way, when they looked at the dollar or a paper currency relative to gold. Gold was the quote unquote standard, and the dollar's value relative to that standard was the return. So you either outpaced the return or you underperformed the return.
Yes.
And that's so what you're using is the staking yield as that constant, and the inflation of the proof of stake system as that gauge. And lucky for us, if you compound, you will always beat it.
Yeah, 90% of the time.
It's going to be very difficult to screw that up.
Yeah.
So you can outpace the inflation of a written inflationary mechanism because the code of the inflation is not going to change. They're not going to increase it like they do stimulus.
Yeah, you know what I mean? Exactly. Yeah.
You know what I mean? Because they see a need that's greater, so they increase this. So why I thought this was so great, and I'm so happy you're sharing this, and I'll give you the floor back in a second. But it's with these kind of tools that we can apply good game theory, therefore create good strategies, therefore continue as investors to produce better and better outcomes for ourselves and the people that are doing the same things, as opposed to those who are reacting emotionally in the market, because the market is filled with emotional people that are going to do things against simple math equations. And if we stick with the math equations, we're winners.
Yeah, and we've got to keep it simple as possible as well. It's simple because accessible, and it's so hard to make a decision on something complex, right? I mean, I've done a little bit of trading, a bit of technical analysis, and the more complicated you make it, the more you give yourself a chance to make a mistake because it's complicated. You know, let's say you've got a decision tree for your investments and you've got 20 decisions you need to make before you buy something. Well, I think that's 20 opportunities to make the wrong decision along the way. Whereas if you just got a 2-step, 3-step decision tree, then it's much easier. I know that's just like kind of, there's no context on that example really, but hopefully it just kind
I think there's a lot of context. You know, I kept my initial, for the first couple of years, very simple. Does the product have a fit somewhere? And if so, I'm going to invest in it only if I can find a place for it to earn yield, right? So I can put my $100 in now, walk away, and it will always earn more on some scheduled basis.
Yeah.
Well, those are two decisions. If it's yes and yes, I do it and walk away.
Totally.
Right?
Yeah.
It's not rocket science.
And you even did it with your thesis for investing. I think you went with a lot of layer ones specifically. So it's almost like you said, hey, layer ones, I really like that sector. I think there's a lot of value in what they offer. And my thesis is layer ones are a good investment. And you said you picked 21 layer ones. That makes a lot of sense to me. I really resonate with that.
By now, but yeah, the thinking was, I don't know what foundation an application that will reach 1 billion people is going to be built on. I don't know which foundation, but there will be one.
Yep.
I just don't know which one. So I'm taking a shotgun approach at the layer ones.
Yeah.
I have more of some than others just because, I don't know, I have an emotional connection to like Cardano. I really like it. I really like Cosmos. So therefore I'm like really in the Cosmos space.
With regards to the layer ones, I actually feel like there's one challenge to sort of having a lot of only layer ones, in the sense that, you know, a layer one hosts a lot of applications, right? It depends on your definition of a layer one. Osmosis is a layer one, but it just hosts the Osmosis application. I think most people look at layer ones as a blockchain that can host multiple different applications. It has the bottom layer, the first layer, hence layer one, on top of where everything else is built on top. The one like thing I've actually found with Cosmos, especially recently, is I started believing in like a multi-chain world with cross-chain bridges. And then I started understanding what's called application-specific blockchains, which is essentially a blockchain with that first layer being customized specifically to host a particular type of application. It's customized in a way to optimize for maybe a decentralized exchange to be built on top of it, or maybe it's optimized for a gaming economy, or maybe it's optimized for NFT creation. You know, maybe it's optimized for Airbnb, as an example, NFTs and Airbnb. So like, if you have like this sort of thought process of application specific chains are really cool innovation, really good idea. And you also have this idea that the ecosystem is going to be going from a walled garden scenario where one chain is isolated from another to a scenario where everything interoperates and you transact between all these different chains. You start thinking like, well, is there a need for layer ones at all? And there is a need, I think, but you start thinking down this process of, you know, whether or not over time, every chain is just going to become one chain with one specific application. And that opens up a whole like whole can of worms, actually.
You know, I hear what you're saying, and I think from a perspective or context of, there will be users, right? There will be users who, to them, it will feel like one thing.
Yes. Yeah.
Like for my son, when he was 3 and he got his very first generation iPad, and he could go on the internet, to him, the iPad was a portal to one thing, the internet.
Yeah.
You and I understand the internet is a bunch of things. There will be a Wi-Fi moment for blockchain where my app that was built on something I might not even know what it is will interact with an app or a blockchain that you're dealing with, and I won't even know it. That ubiquitous, seamless interaction or trading of value because of underpinning protocols like IBC, et cetera, et cetera, et cetera. I believe that's coming. I don't know when. I think IBC is probably our closest technology to that right now, right? I don't know of anybody. I mean, Polkadot's trying to do it, but Polkadot isn't there yet.
Yep.
IBC is. Look at that. All those things are actually working and doing things.
Yeah. Can you still see my screen?
Oh, absolutely. You're the guy who introduced me to the map of zones. I think this is wonderful.
It's a very nice visualization. And I was trying to like actually close the screen because we were chatting different from the RO multiplier. But yeah, I mean, Polkadot isn't as far ahead as Cosmos in terms of, like you say, the interoperability element. I think you're spot on that a lot of people are going to use multiple chains without it feeling like they've ever moved chain, as we know it today. I mean, if some of your viewers haven't used crypto that much, they might not kind of understand that. But when you have used crypto, you kind of know when you've used one chain or used something else. It's almost like having two apps that do the same function, and then you click one app, but if you want to use the other one, you close the app and go on to another. It's fragmented, right? And that's kind of like what it's like chain wise in blockchain. If you're using like a exchange on Osmosis and then you go and use Uniswap, it feels like you're using a different blockchain or a different app.
There's no question. However, though, because I'm actually interacting with quite a few of the projects in the Cosmos ecosystem, and I will tell you that the stuff that's coming up, I would not even have thought of 4 months ago. And 4 months ago, I consider myself a veteran in the digital asset space, right? Case in point, let's talk about a Confident in Crypto video where we're not necessarily talking about specific airdrops, but the potential of things to come, like, what if Terra started validating on a validating for a new chain, and that new chain is now going to reward anybody that used the Terra validator, or I'm a new chain, and as a fundraising mechanism, without asking for crowd loan or you to give me money, I'm just asking you to stake to my validator, and my rewards I earn, and when I launch my chain, I will give you an airdrop. How's that?
Yeah.
I mean, there's so many different combinations of this. These were things I never thought of before, but they totally play into a behavioral economic model of let's incentivize people to help us, but also have them. I mean, they won't help us otherwise. Most likely, 1% of the population in crypto would help. But if you incentivize them with monetary reward, 99% of them will help.
I think that's the crypto. Yeah, I don't think that's just airdrops. I think that's just the whole model in cryptocurrency, right? It's these sort of financial incentives to onboard new users, to help each other in different ways, to put value on intangible assets that we couldn't previously value. So just community value, reputation. There's a lot of philosophical theory and discussion, debate around that kind of like those incentive structures. First of all, do you know how to close? I can't close the. I don't know how to close my screen share. So I don't know if you can do it your end.
Sure.
Just since we're like chatting, it's probably better we're both sort of in the big picture. Thanks so much. I literally couldn't find. That's why I've been like trying to do that for 5 minutes. And
okay, sorry about that. We're
good.
Towards the end here, I've got two things. One, I want to give an opportunity for final thoughts, and the second thing I want to do is just commend you. There are young men like yourself, you, Cryptocito. There's a few other guys, Cardano, Paul. There are guys in this space bringing information that are helping people, and I'm watching your channels grow, and I think that's great. 2 years in the game, I don't care about my user count. I do this for me. You know what I mean? And I can tell that you're doing what you do for you, but I know it would help if more people subscribe, more people would get the information. And you're bringing light to an area that doesn't get a lot of light shined on it, and that is the Cosmos ecosystem and a lot of the things that you can do with proof of stake systems, whether it be Polkadot, et cetera, et cetera, et cetera. So everybody, Confident in Crypto, link to his channel below in the description. Please go subscribe and check out Liam. And Liam, final thoughts.
Well, I just wanted to say, if you want to dive into the return on investment multiplier, we can revisit that, or I can share it with you for your followers, because we didn't actually go through the full equation. So if anyone's wondering, you know, what happened with that, you know, I'm happy to share it with you.
Episode number 2.
Yeah, exactly. Perfect. And we can break it down a bit more. I say just remember the bonded ratio compared to the inflation rate is the main equation today. So if you divide the inflation rate by the bonded ratio, times it by 100, you'll get staking rewards, an estimation. But yeah, if I was to leave like anyone with anything today, I think anyone can get involved in crypto and in finance as well. We didn't talk so much about, you know, how we got into finance, you know, both of us, but I started off with only an interest in business and economics, and I just put in the work. I explored what interested me, and like you said, Jerry, you know, I do this for myself. I learn all of this, and then I just share it with other people because I believe the information is valuable to them too. So my journey's just been about learning as I go. The space moves so fast; there's always more to learn. It's super exciting, and the sooner you start, the sooner you kind of get up to speed with things. I think anyone can do it. The trick is just getting started somewhere. So I'd like to leave people with that. And if you do want to follow me, it is Confident in Crypto, as Jerry mentioned. And I'm also on Twitter at L1AM_crypto. And I do post on there as well. And if you want to get involved in Cosmos, there's a massive community there. And I do think what they're doing is the future, whether or not Cosmos will be the future, you know, the future itself, sorry, should I say. I believe in that philosophy personally. Thanks for having me, Jerry, as well. Massive shout out to Jerry. If any of my viewers are watching this on Jerry's channel, subscribe. Sounds like you've got a lot of insight. And thank you for having me.
You're the best, man. We will do this again. Thanks for everybody for tuning in. Please leave your comments. And until next time, Pura Vida.